SCHG's higher return came with a deeper crash, but it recovered over 5 months faster than IUSG did. SCHG bounced back in just under a year, while IUSG took nearly 17 months to fully recover from losses. SCHG's 102% 5-year return doubles your money. That's the power of patient, long-term compounding paying off. USG's 97% 5-year return trails by 5 points. That gap snowballs into serious money over decades. SCHG edged ahead over 5 years, but just barely. Like race cars neck and neck, the gap's so tight you'd need a photo finish to tell them apart. IUSG's 21% return shows strong momentum. This recent surge signals the tide's turning in its favor. SCHG's 16% return trails by 5 points. IUSG's clearly winning the recent market momentum battle here. Both funds matched perfectly at 0.6. They're delivering identical returns for every unit of risk you're taking. IUSG's Sharpe ratio of 0.8 means you're getting solid returns without taking on excessive risk lately. SCHG's 0.6 Sharpe ratio shows decent risk-adjusted returns, but IUSG's delivering more bang for your buck lately. Think of Sharpe ratio as your investment report card. Higher scores mean better returns for the risk you're taking. Pretty straightforward grading system. IUSG's 32% crash feels manageable compared to alternatives. That 3-point cushion matters when you're sweating through downturns. SCHG's 35% crash tests your conviction. Deeper losses make it harder to hold on when markets turn ugly. SCHG crashed harder, but bounced back way faster. Proof that deeper wounds don't always mean longer healing times. SCHG's bigger fall meant a sharper bounce back, while IUSG's smaller stumble led to a longer recovery, like tightrope walkers steadying themselves after different-sized wobbles. Both funds charge exactly 0.04% annually, so fees won't help you decide between these two contenders. SCHG's 9% turnover means it's barely trading, keeping more money in your pocket from taxes and fees. SCHG wins long-term at 102%, but IUSG's steadier ride shows in that smaller drawdown. Recent momentum's flipped, though. IUSG's pulling ahead at 21%. IUSG's 36% turnover means more tax bills and trading costs eating into your actual returns each year. Portfolio turnovers like couch change. Every trade costs you coins and taxes and fees. SCHG's lower turnover means you're keeping more of those coins. IUSG spreads your risk across 463 stocks. That's serious diversification protecting you from single stock disasters. SCHG keeps it tight with just 196 holdings. More punch per stock, but you're rolling with higher concentration risk here. IUSG's 463 holdings spread your risk far wider than SCHG's 196. It's the classic egg basket wisdom. One stock tanks, you'll barely feel it. Both funds nailed identical downside protection. A 0.8 Sortino means they handled the rough patches equally well. IUSG's 1.1 Sortino ratio means it delivers better returns, while protecting you from the painful downside volatility that kills portfolios. SCHG's 0.8 Sortino ratio is decent, but IUSG managed better downside protection over the trailing 12 months. Now, IUSG's recent shelter looks tougher. Its 1.1 rating beats 0.8, though both funds weathered the 5-year storm equally well. Risk profiles are nearly identical here. Just 1 percentage point separates them for long-term investors. So here's the bottom line. SCHG for maximum returns with bigger swings, IUSG for smoother diversified growth. SCHG's been the slightly faster marathoner over the long haul, while IUSG spreads its bets wider and recently found its stride. Different strategies, similar finish lines. All right, you've seen the data. Now here's the legal stuff protecting everyone involved. If you found this helpful, hit subscribe for weekly deep dives on ETFs and smarter investing strategies.